Good morning. We had a busy week this week. Fannie Mae has actually come out with a couple new guidelines that should help several people. The market up, down, this way, that way. Good morning. I'm Brendan Rendo with the Homes Orlando team, joined as always by Joseph Dion of Apley Home Loans. And we, of course, Hey, Joe, how are you?
Hey, doing good. It's glad to be back. Was traveling West Coast side last week for some conferences and just trying to stay up to speed on what's happening and changing in the industry. And this last week was a little adventurous.
It was, but it's going to be kind of nice that we can come out with a little bit of good news, some changes in the Fannie Mae guidelines that I think will help several different people out there. So let's hop in and let's take a look at some of the changes. So this just came out October 4th.
Yep.
And probably one of the bigger ones is, and this is your specialty, so I'm going to let you go through this.
Yeah, I think the biggest one right here is on 2-unit and 3 to 4. So 2 to 4 unit purchases, they dropped down the minimum down payment so we went from on a 2-unit for a primary purchase, so somebody buying a duplex, right? They had to put 15% down. Well, now they can put 5%. And the same goes into effect for 3 to 4 units. Now, the key here, though, is that your automated underwriting system can be very, very, it's going to be very sensitive. And you got to make sure that it's going to want to see like higher credit borrowers. It's going to want to see reserves. It's going to want to see all those things. They're not giving the dynamic of what all they're looking for on that spectrum, but we've already ran a number of scenarios for borrowers. And I've had some that I'm like, slam dunk, should get an approval, didn't get an approval. Single family approved all day. But the moment I go to a duplex, I wasn't able to get the approval at 5% down. So it's going to be the rules there, the changes there. It's a positive change. But we're going to have to play with it and get some experience with what are they going to be looking for in that underwriting finding, so we know how likely or how many borrowers potentially this can help.
Gotcha. But it'll be nice for those people who want to look at the duplexes. I mean, the duplexes aren't quite as relevant here in Florida as they were where I grew up in upstate New York. There are a lot of homes that were duplexes, but it still gives that opportunity for people, because really I think the only alternative was FHA, correct?
Was FHA, exactly.
Did allow some?
Yeah, because FHA would allow 3.5% down on that duplex. So this gives that option, that conventional option that wasn't really there before for that first-time buyer or second-time buyer trying to buy this.
Wonderful. Then I think the other big one is way down here.
And we're going way down, self-employed borrowers. So this
self-employed borrowers.
So this one's kind of fun. Really what it's doing is there's some guideline changes, a lot of little bit piece, but there have always been the ability to kind of use 1 year instead of 2 years, a lot harder to get. I think some of this is really clarifying, and it's going to allow for a little bit easier to get a 1-year finding with your AUS, your automated underwriting system findings, for a self-employed borrower with 1 year. Where is that a benefit? Somebody that maybe they just started their company a year and a half ago, so they don't have the full 2 years of self-employed. But they have 1 full year of tax returns for that. Or it could be in those situations for those borrowers that maybe they have more than enough time, but last year was much, much more profitable, much more dynamic than the prior year. So it's helping them with qualify for a little bit more by only requiring that 1 year finding.
Yeah, that's a great point, because it's always been easier to go from self-employed to getting a paycheck, but going from a paycheck to self-employed has always been tough for people.
Yeah.
And it's still something that you need to spend some time with your lender and with your accountant to make sure all the numbers come together properly.
Absolutely.
Because once you put something out there, you can't pull it back, correct?
Exactly. It's a lot harder. There's certain instances we always have in like borrowers, or I talk to individuals and they say, they'll revise their tax returns, right? They'll resubmit. What is the word I'm blanking on? But when it comes to those tax returns, kind of once you file it, if you amend your tax returns to qualify, underwriters don't look down on that. And a lot of times they'll reject an amended return if it's significantly higher than the original one. So this is where, like you said, it's so important to make sure you're speaking to your loan originator and your accountant. Everybody's on the same page. That way, when you put the documentation in place, it's settled, it's good. You know you're going to be in good shape.
Gotcha. And then the other item is there was a slight increase in maximum loan amount, correct?
Yeah. So this is the one that every realtor, every loan officer has probably already posted on social media about. But if you haven't seen it, we went from 726,200 as your standard conforming loan limit. There's certain areas in the nation that are a little bit higher than that. And then the next year, so for next year, it's going to go up to 750,000 maximum loan amount. Now, the big key here is that we already have lenders accepting that higher loan amount. And what they're basically doing is they're going to hold those notes. They're going to wait till next year, like January of next year, rerun AUS for that file, make sure they're still proof eligible, and then they'll sell it off to Fannie Mae, Freddie Mac, or whatnot. But kind of that changes to about, you're talking $23,800 increase, and your standard loan amount for conventional. We haven't seen FHA's post yet, so we'll know. Usually that comes out mid to late November is when we see that.
Yeah, it always comes a little bit later.
Yeah,
that's probably one of the smallest increases we've seen in a number of years.
Yeah, overall.
It's funny because I kind of remember when it went. I think it was to 225 or 325, and everyone was excited beyond belief. Now you're looking at
I think it was like 414 or something was the year.
Yeah.
That it was like, oh my gosh, we got so much money. Like,
and then you're looking at the jumbo rates. Oh, how do I get it below that number so I don't have to go into the jumbo rates?
Yep.
Oh, I remember those days. That was interesting. So, and then the other thing that happened, and we got the numbers out this morning, is CPI came out this morning.
Yeah.
We had PPI yesterday, which we'll hit that as well. So we came in a little higher than what people had expected. They were looking at 0.3%, and we came in at 0.4%. And where did we see the biggest adjustment? We're still seeing a very high inflation rate on transportation. It's just holding up there. And then the other place is shelter again. And until this shelter number starts pulling back, you're not going to see that inflation number, I really think, break that 2%. Because month over month, we actually went in August from a 0.3% increase to 0.6%.
Oh, wow.
So this actually makes up 34% of the overall inflation number.
Yeah, so that's going up.
Yeah, this is one we've got to pull down
in general.
Yep. And I had to look it up because I wanted to make sure of what's included in this. And this is their actual breakdown. So you see shelter's going to be 34.4% of the overall number for inflation rate. And 25% of it is owner's equivalent rent of residence and primary residence. And we joke about it, but it is actually true. This is actually in their documentation. This is how they get that number. If someone were to rent your home today, how much do you think it would rent for monthly, unfurnished and without utilities?
Wait a minute. So we're coming up with this number that has a massive impact on our inflation. And we're basing this on a phone call to owners to say, how much do you think your house is going to rent for?
Yeah. How much is yours going to rent for, Joe?
I don't know. I'm pretty sure I can get $6,000 a month for my house. Brendan's laughing because he sold me my house, and he knows that is not reality.
Yeah. Yeah, you get sick. Well, you got the pool. So I don't have a pool, so I'm probably only going to get $5,000.
You know what? I will rent my house tomorrow. You give me $6,000. It'll be rented tomorrow.
So you look at this and it's just kind of mind blowing that the Fed is actually basing policy off of that question.
Yeah, that seems crazy to me.
It seems kind of crazy. Then we hop over in this was the interesting one, the producer price index, because the target yesterday was 1.6%, and it came in hot at 2.2%.
It was scorching.
It was very hot, but and then they revised last month's number up to 2.0,
which makes this month's increase not look as bad.
Yeah. So it doesn't look quite as bad, But when you look back at the overall PPI from September of 2022, we were sitting 8.5%.
Yep.
And you have seen a pretty steady decrease until the past couple of months. When we hit a low here in June of 0.2%. That was nice. That was very nice. Yeah. But July, August, and September, we're starting to see some push back up. And the Fed's kind of got to be looking at that going, do we need to do an increase?
Yeah.
But I'm wondering if some of that's from a lot of these union situations where they're negotiating, pay increases that they haven't had for the past 10 years.
Yeah.
So that could be a factor that's kind of pushing things up a little bit overall.
Yeah, and I think we can potentially, with energy costs, that's what I'm curious with the energy costs. What are we going to be looking like? We've seen this thing with Russia and Ukraine has impacted energy, kind of pulled away. We've tapped into a lot of reserves. We've done this, but now you've got the thing with Israel and Hamas. You're dealing with that over, and do we see these numbers continue to go up in the next couple of months? Because the biggest factor, I think, when we're looking at this has been energy over the last few months. When we see the big shifts, has been shifts in energy costs.
Yeah. Well, when you look at August energy was our biggest shift, 10.3%.
Yeah.
And September, again, energy, 3.3%. So you're right. Energy has been the biggest one. OPEC did come out and say that they're not going to touch anything. You'll know if they're going to adjust anything because they're going to have a minister meeting. If they have a minister's meeting, then we're probably going to see either production increases, but also a possible increase in pricing. But so far, they've kind of held steady. But they said if this conflict continues to go on for an extended period of time, then they are going to have to more than likely have a minister's meeting and see where things are going to flow from there.
Yeah. You know who's not worried about inflation right now?
Who?
The person that won the Powerball last night.
Oh my gosh, that was a 1.75 billion.
One person. Wow, that's nice. Oh, too bad they live in California, so that's going to stink for them.
Kind of. So after taxes, he's going to get about 1.2 million. That's good. Oh man, congratulations to him. That's awesome.
I just saw the headline. I just laughed at that.
Well, one thing that's interesting is, though, even with some of this inflation news, we've actually seen over the past couple days, and this has been nice relief, is some pullback in the mortgage interest rates after hitting a peak, around 4.8. The 10-year T. We pulled back to 4.6. Went a little lower yesterday. We're in 4.5.
Would have liked to stay lower.
Yeah.
But much, much better than where we were a week ago.
Yeah. Oh, you'd much rather see the chart go like this any day of the week.
Any day.
This, of course, was Columbus Day, so markets were closed. But you're seeing that pullback right now, which even with the amount of debt being put out there, Yellen, I believe, was $275 billion worth of debt last week. T-bills put out last week, that the 10-year T is still pulling back a little bit.
Mhm.
And the good thing is people right now, you got 94% of the market saying Powell's not going to move in November,
Yeah.
that he's going to hold.
What do you think's causing that though? Like,
I think
you
it's,
see, I'm looking at it and I go, what's kind of maneuvering, because we are getting these, CPI, PPI, like these things are coming out a little bit hotter than expected, which would usually say that they're going to look to bump rates again. So why do we have the consensus that we're not?
I think it's this right here. This. In that we had a reaction in the treasury market over the past month that I don't think that they expected. I think they expected a little bit of an increase after Powell's meeting, but I don't think they saw the jump that we were going to have. And I think that's what it is. And I think people are kind of, the interest rate jump, quite honestly, is more than enough to give Powell the effect that he wants, which is pull back and slow down the economy.
Yeah.
The jobs report came out last week, and of course, the headline, they always write the headline to look great. 336,000 new jobs, but what they didn't tell you was over half of them were part-time jobs.
Well,
and and the number of full-time employees went down.
Yep.
And the number of people holding two jobs went up.
Mm-hmm.
So you always got to delve into that information and actually really look at it. And even going into December right now, we're still over 60% of people believe that they're not going to do a rate increase. It's a pullback from last week, which was 71%. But I think the big thing to watch the end of this week and beginning of next week, bank earnings start to come out.
Yeah.
And the banks are taking huge hits on their bonds.
Yeah.
Absolutely huge hits. So the profitability of not only the big banks, but more importantly, the regional banks, I think that's the big thing to watch. And I think if they're weak, or I mean extremely weak, that I think it's an alarm bell for Powell too, that, hey, you pushed it too far, because you don't need those. We don't need another, 100 banks going under, because, their bond, they can't sell their bonds, or if they do have to sell their bonds to raise money, they're taking such a discount on them to get rid of them, to raise cash, that it's going to force them basically to go under.
Yeah, I think, like you said, like with a lot of this in the next couple of weeks, is going to be really, really imperative. One bank in particular that, as they report their Q3 earnings, that I'm really interested in is Truist. A lot of pieces that I feel have kind of happened with Truist in the news recently. So you had some of their C-suite executives resign. You had some of their board members leave. You have them trying to sell off one of their most profitable divisions, being insurance. For why do that? Seems like there could be some turmoil with Truist that could have an impact on the bank. And that's a major, major bank. That's one where it could have a big move, and that news can have a really big impact on the economy. If we see something, obviously nothing like Silicon Valley or anything, not going to see anything like that. But it's the first time that I've really seen one of these big powerhouse banks really sit there and go, hey, there's some turmoil here.
Yeah. I mean, there's a number of people coming out with some warnings. You actually had a chance to talk to one of the gentlemen from Fannie Mae.
Yeah, Doug Duncan. So I was at AIM Fuse, which was their big conference. We had Doug Duncan, which is the chief economist. And obviously they give their little quotation asterisks, like this is not official, blah, blah, blah. We will not hold by this by any means. But it was kind of really interesting to see his stance. And he's like, he's speaking way up here. And I'm, I'm just a little peon on the ground floor type thing when it comes to this knowledge stuff. But it was kind of interesting to see his conversation talking points. He thinks that probably, potentially no more increases this year, but they're citing that if if something were to happen, there might be an increase in December and so forth. But he does expect to see rates start to take a pullback maybe late 2024 is what they're predicting on Fannie Mae side. A lot of other people are predicting Q2 potentially for rates to start taking a pullback and come back down. Nobody in their right mind is predicting rates in the 3s or 4s. I'm seeing a lot, and I think Fannie Mae, even kind of what he was kind of alluding to, is maybe high 5s, low 6s, which would be, awesome, right? I think comfortably, we've been saying this for the better part of a year, of if the rates stay in that 6 range, like that low 6, high 5 range, that's going to be healthy, that's going to be sustainable, and that's something that, we can look for a balanced market.
Yeah, because I think we saw that once they hit that, was it 6, roughly about 6.5, the market just kind of froze, and it's been frozen really ever since then. So yeah, I agree with you wholeheartedly. I think that's, if we can get back into that, low 6s, high 5s, and have a nice couple of years of floating in between there, I think we can have a great, a great business again. A steady, not crazy, not too slow, but a nice middle ground that's gonna help everybody overall.
Yeah,
with it. So let's hop in to our Orlando numbers, and what we're seeing is what we've seen really all through September and most of October, in that besides the final week of the month, we're seeing a pullback on the number of sales. So again, we pull back into the mid 300s overall sales, and our inventory continues to increase again. We've got another 100 plus homes on the market. So we're almost at that 5,000 home listing mark right now. And then the condo market really has slowed to a snail, with only 133, and their inventory is continuing to increase.
Yeah.
And I'll give you for instance, I've got a client, I'm actually going to go through all the condos in Altamont and Longwood and do a comparison of the HOA fees, because that's been the biggest holdback for everybody. Is, last year, you pretty much were in that 300, 350 range for most locations around Altamont Springs, Longwood, throughout Seminole County. But with the insurance adjustments, some of them have been $100 increase, some of them have been $200. One place has actually was a $300 increase in their HOA fees.
Yeah, which is a big impact. I mean, you're talking that HOA $300. That's, gosh, you're talking almost a 30, 40, 50,000-ish increase in buying power if you didn't have an HOA.
If you didn't have the HOA, exactly.
So that affordability piece, right, becomes a bigger question. Yeah, it costs less for the condo than the single family, but is it the more affordable option?
Yep, exactly. And then here's the big thing, which we look at every week. Original list price to sales price. We have dropped down to just over 93% on original to list. And it's not just the high-end stuff. You do see the 86% here. So again, some of these higher end homes are really starting to have to cut their prices to be able to move on the market for people. I mean, that extra 23,000 not going to make it up at that level, on the new loan limits. But you look right across the board and you see, original 94%, 95, 96, 94, 95. So everyone is having to drop their prices in order to get their houses sold.
Yeah.
And our days on market is holding up as well. So this is where, if we look at it right as a buyer, you really are kind of starting to move into more of a buyer's market. And if you sit down with your loan officer and your realtor and you use them as a team together, don't use them separate, use them as a team. You can sit there and you can, look at your numbers, look specifically at the neighborhood you're looking at, and you can run the numbers and figure out, okay, I can get myself, if I'm able to get $12,000 on a $400,000 house, for closing costs, Joe, if I use 8 of that to buy down my interest rate, do I get myself from that 7.75? Can I get myself down to the 6.75 or maybe just a little bit lower? And Brendan, can I still use some of this for my closing costs? What is my overall out of pocket going to be? And
Mhm.
what's the best way to put together, a beneficial package so that when I go in here and we make this offer, we've got the best presentation we have, and it's going to make the most financial sense for me overall.
Yeah.
So it's more work on our part, but it's what we need to do for our clients.
It's really being a full, like, it's kind of that being a full advisor, right?
Yep.
Like, not just an order taker, not just someone that opens the door, right? It's actually sitting there and going and saying, hey, Brendan, you're the realtor. Joe, you're the mortgage professional. Give me the advice that's going to set me up with the best scenario possible, right? Like, what's going to give me the best purchase price terms? And right now we know exactly like you said, seller credits are out there. Like, I talked to a borrower and they were pre-approved a year ago, followed back up to them. And I was like, look, market's a little bit different. A year ago, you weren't getting seller credits. You have that ability now. Ask for them, right?
Yep.
Take advantage of them.
Yep.
And we were able to kind of go over exactly what you said of, hey, if we do this, this, and this keeps your payment here. Is that comfortable for you? Right? Because at the end of the day, everything starts with and ends with, in my mind, the payment for that borrower when it comes to the mortgage world, right? Like, if you got to be comfortable with the payment. We can have anything over here, right? But if you're not comfortable with the payment, then it doesn't matter how much you qualify for. It doesn't matter what you can do, right? A lot of borrowers qualify for, they may qualify for a $500,000-$600,000 home, but they're not comfortable with the mortgage over $2,000. And really, in this marketplace, that's not going to be anywhere near a $500,000 home.
No.
Right? It's going to be way, way below. So we've got to have those conversations up front. That way, they're not wasting their time and they're not wasting realtors' times looking at properties that they're not going to be comfortable with the payment.
Yep. It's not always a pleasant conversation, but it's ones that we have to have them.
Yep.
We really do. And then, you see here the graph wise, again, you see really kind of leveled out and kind of a slow decline in the number of sales.
Mm-hmm.
And I think we're just going to stay in this average. We may get down to a 400 average over the next couple of weeks. And that's, again, because of current interest rates.
Yeah.
And here it is, inventory. We're actually over 5% above where we were in January.
Wow.
So that's why you're seeing the original list to final sales price, that percentage starting to increase.
Yeah.
It's because there are more homes on the market. You don't feel pressure to accept something you're not comfortable with.
And I'm just curious. I heard this conversation a lot, and I want to get your take on it, right? Back historically, we've always said a neutral market is what, like 6 months supply, right?
Correct.
Right. So that's like historic. But we're not there anymore. And I think technology has really changed that. And a neutral market might be a 3 to 4 month supply now.
Yeah, I truly think a neutral market is more like 3 months. To me, it's not 6.
It's definitely, and that's a new way of thinking, right? There's a lot of professionals that are still leaning toward 6 months, but the reality is with how quickly things can move now, 3 months is probably the realistic number.
Yeah. And you see it with a lot of sellers where, after 30 days now, because your house has been all over the internet.
Yeah.
It literally is all over the internet. And you'll see where, we just withdrew one. And reason being is that where it was located within that subdivision, if they had put it on the market 3 months earlier, we would have gotten the price. But now there were 4 home sales within the subdivision that all of a sudden the price dropped out the bottom, that were, really 30, 40,000, $50,000 below what they should have been. And when we reran the numbers, okay, based off these current 4 sales, we basically we're down about $30,000 on what the house is going to appraise for.
Gotcha.
And that's not where you need to be. So you know what? It's not doing us any good just leaving it on the market. We can pull it off.
Yep.
And just watch the market. And if we see the market start to heat back up, maybe early spring, it may be a time to put it back on. But right now there's just no benefit. And even if we look at the current pendings, we're not going to be able to support the price of that house. And there are pockets right now within Orlando where you're starting to see home prices pull back some. Not anything crazy, but 2-3% drop that we haven't seen in a long time. I run the numbers. For instance, it's interesting because you run the numbers in Altamont. Altamont's got a month supply of inventory, and we've actually increased about 6%. I think it is over the year in Altamont, but there's also, again, no inventory in Altamont. But you go out Sorrento, Eustis, inventory's booming right now. And you're starting to see the prices pull back. And this is, one that I'm starting to keep an eye on a lot, which is your temporary off market and the withdrawn. And you see the end of the month, all of a sudden you saw a spike in withdrawn. And it's really kind of the same conversation I probably had with my people, is the market's pulling back a little bit. And I know you want this price, but right now with the current situation, I don't see it. So they didn't have to sell. They kind of wanted to sell.
Yep.
But they didn't have to sell. So, okay, that makes perfect sense for everybody there.
Awesome.
And in the condo market, we're seeing the same thing. Pullback on the original list to sales price. We're down to 96%. Days on market pulled back a little bit, but sales have just, straight down for condos. And that's where, I think condos over the next year, until maybe they get some kind of insurance relief, it's going to be a tougher time to try and sell condos and get, you're definitely going to be coming off your peak prices with the condos, definitely coming off peaks.
Yeah.
Because you just can't sell it for this much and have a new HOA over here at this much. So, but that's our news. Thank you for joining us. Please, as always, like and subscribe and join us every Thursday. Joe, thanks again for joining us. Always a pleasure to have you.
Absolutely. Love it.
Take care.